CT Real Estate Investment Trust delivered a narrow miss on revenue for its Q2 2026 earnings. Diving right into the headlines, Q2 property revenue came in at $156.71 million.
Right, which is a 0.25% miss against the $157.1 million Wall Street consensus.
Exactly, though it was actually still up 4.6% year over year. And basic GAAP earnings per share hit C2.529s, up 164.6% year over year.
Yeah, but as we know, for a REIT, GAAP EPS is kind of just noise. Diluted funds from operations, or FFO, is the real metric here, and that grew 3.2% to C2.353 cents per unit.
Yeah, and adjusted funds from operations, the AFFO per unit, rose 2.5% to 0.1326, which is incredibly solid, but the market reaction was initially pretty muted.
Yeah, it was. Units slid a nominal 0.17% in after-hours trading and closed virtually flat, up just 0.06% the following day.
But then by day two, the stock popped 1.41% to C$17.93. Institutional investors finally digested that operational stability and the low payout ratio. Right, so the top-line revenue misspooked the algorithms for a minute, but the underlying operations ultimately won out. So let's look at those operations, because the cash flow story here is pretty aggressive.
It really is. I mean, same property net operating income, the NOI, increased by 2.5%.
Mm-hmm. And overall, NOI jumped 4.8% to see $124.66 million year over year. The sources attribute that to contractual rent escalations and completed intensification projects.
Yeah, but the number that really jumps off the page is the portfolio occupancy. It's sitting at an exceptionally high 99.5%.
Okay, let's unpack this. Imagine you are a residential landlord. You own an apartment building, and you basically never have a single vacant apartment. Nobody leaves. But somehow, when those leases come up for renewal, you still manage to hike the rent by double digits across the board.
Yeah, it's wild. They completed over 618,000 square feet of lease renewals at a blended rental increase of 10.4%.
Which is massive. But if they're sitting at 99.5% occupancy, doesn't that fundamentally mean CT REIT has hit a growth ceiling? I mean, they have almost no empty space left to lease out.
Well, the ceiling assumes you need empty space to grow, but that 10.4% spread shows they have incredible pricing power with the space they already have.
Right.
And we can actually split that 10.4% up. You have Canadian Tire store renewals, which was 515,000 square feet of that total, seeing a 10.9% increase.
Okay.
But then third-party tenants, which made up the remaining 103,000 square feet, they absorbed an 8.3% increase.
Oh, wow. So they aren't just, squeezing their parent company to juice the numbers. They're hitting independent businesses with high single-digit rent hikes, too.
Exactly. It proves they hold pricing leverage across completely different tenant classes.
Yeah, and that dynamic forces us to look at the elephant in the room here, the massive tenant concentration. It might be the most defining structural element of this whole trust.
Oh, absolutely.
Because Canadian Tire Corporation, CTC, accounts for 92.0% of the trust's total gross leasable area.
Right, and 90.6% of its annualized base minimum rent.
It's huge. And the weighted average lease term, the WALT, is incredibly long. It's 6.9 years overall and 7.1 years specifically for those CTC leases.
Yeah, they're locked in.
But, and this is a big but, our sources highlight a major strategic shift happening at the corporate level. Canadian Tire is pivoting from its better connected strategy to a new True North strategy.
Yeah, right, the True North pivot.
Yeah, and that explicitly places less emphasis on new store development. So I have to challenge this setup. Are we looking at an independent real estate trust or just Canadian Tire's captive property management arm? Because relying on one tenant for 90% of your revenue feels like putting all your eggs in one heavily branded basket.
What's fascinating here is how that concentration actually acts as a defensive moat rather than a pure risk.
A moat? How so?
Well, the financial ties are deeply symbiotic. For example, CTC provides a $300 million credit facility directly to the REIT.
Wait, really? The tenant is the lender?
Yes, and right now it's drawn by $113 million. That ensures the REIT has immediate liquidity backed by a massive national retailer. But to your point, I have to be completely impartial here. The True North pivot is a real hurdle. Because CTC is big in fewer stores, the REIT can no longer rely purely on its parent company dropping new retail locations into their lap for easy growth.
Right, which naturally begs the question, where does CT REIT's future revenue growth come from then? This pushes our deep dive right into capital allocation and sourcing new growth.
Yeah, they have to look at developments and third-party acquisitions now.
Exactly. So in Q2, They invested $76 million to add 232,300 square feet of gross leasable area.
Which included a multi-tenant property in Edmonton, right?
Yeah, an Edmonton property, a retail property in Rosemere, and several store intensifications in BC and Quebec.
They also completed a $13 million vend-in from CTC in St. Catharines.
Let's quickly define that for everyone. A vend-in is basically an asset transfer where the parent company takes a property it already owns and sells it to the REIT.
Right. And management noted they still have 10 to 15 potential future vend-in assets remaining.
Which is a nice buffer. But their total development pipeline sits at 9 projects, costing CAD $354 million. And the centerpiece of that is the Canada Square office retrofit.
Yeah, which is due for completion in late 2028.
But listen, management noted on their own call that the broader retail property market right now is tight and competitive. So I have to push back here. If the market is this expensive, is there a risk they are overpaying for third-party acquisitions just to keep the growth engine fed?
If you look at the strategy, they're actually insulating themselves pretty heavily from the volatile open market.
So, because $354 million is a lot of capital risk.
It is, but they've already pre-leased 94.2% of that entire development pipeline.
Oh, okay.
And of that pre-lease space, 91.6% is going directly to Canadian Tire. So they aren't just building on spec and hoping to find tenants in a tough market.
Right, so the Canada Square retrofit isn't a speculative gamble in a dead office market. It's basically built to suit.
Exactly. That drastically de-risks these massive capital expenditures.
Okay, fair enough.
Yeah.
But executing a CAD $354 million development pipeline still requires serious capital. So let's transition to the balance sheet. Can the REIT actually afford this growth in a high interest rate environment?
Well, surprisingly, the balance sheet actually improved in Q2.
Yeah, debt to EBITDA dropped to 6.56 times, down from 6.77 times at year-end 2025.
And their total leverage is sitting at a really low 38.9%.
Which is incredibly healthy. And they successfully issued $300 million in Series K unsecured debentures.
At a highly favorable 3.57% coupon, too.
Right, which boosted their total available liquidity to $312 million. But here's where it gets really interesting.
Okay.
They have a fortress balance sheet, 99.5% occupancy and cheap debt. Why is Wall Street yawning?
The big question.
Because despite these strong fundamentals, analysts universally maintain a hold rating on the stock. Price targets are just clustering around C$18 to C$18.50.
Yeah, and the stock had slumped 2.52% on August 4th and another 1.17% on August 10th right before earnings.
Exactly. Why is everyone just rating this a hold when the internal metrics are so good?
If we connect this to the bigger picture, it's really about the macro reality. CT REIT is fundamentally a net lease vehicle, meaning the tenant pays the taxes, insurance, and maintenance.
Right, the landlord basically just collects a pure rent check.
Exactly. And that predictability means the REIT trades very much like a bond proxy in the financial markets.
Ah, okay.
So when risk-free interest rates are elevated, like government bonds paying out 4 or 5%, retail investors naturally demand higher yields from real estate to justify the equity risk.
Because why buy a stock if a treasury bond pays almost the same yield with zero risk?
Exactly. No matter how good the internal operations are, a REIT trading as a bond proxy is going to face valuation pressure if macroeconomic financing costs remain high.
That makes total sense.
And the market is always looking ahead to refinancing risks. Getting debt at 3.57% today is great, but what happens when older, cheaper debt matures over the next decade?
They'll have to refinance at whatever the prevailing high rates are, which eats right into their AFFO.
Exactly. That's why analysts are playing it safe with a hold.
It's a fascinating look at how macroeconomics can overshadow perfect operational execution. You know, they collect the rent, manage leverage, lock in tenants for 7 years, and maintain that fortress balance sheet. But they can't outrun interest rates.
No one can outrun the macro environment.
Right. And to leave you with a final provocative thought on this deep dive, our sources note that Canadian Tire leases generally have built-in rent escalations of about 1.5% per year.
Which is standard for these long-term net leases.
It is. But if inflation remains sticky, sitting above that 1.5% mark for the next decade, is that 5.6% monthly dividend actually losing purchasing power in real terms?
That's the real danger of being locked in for 7 years.
Exactly. Is the safety of the ultimate net lease fortress actually an illusion of stability in a high inflation world? Something to mull over as you look at your own portfolio yields.
Definitely.
Make sure to follow the show for your daily retail earnings coverage.